In this section, we're going to learn about spread. The spread is simply the difference between the buy and sell prices quoted for a forex pair, otherwise known as bid and ask, respectively. Like many financial markets, when you open a forex position, you'll be presented with two prices. If you want to open a long position or buy a currency pair, you trade at the buy price, which is slightly above the market price. If you want to open a short position or sell a currency pair, you trade at the sell price, slightly below the market price. The spread in Forex is a small cost built into the buy or bid and sell or ask price of every currency pair trade. When you look at the price that's quoted for a currency pair, you will see there's a difference between the buy and sell prices. This is the spread or the bid-ask spread. Changes in the spread are measured by small price movements called pips, which is any change in the fourth decimal place of a currency pair, or in the case of Japanese yen pairs, the second decimal place. It is not only the spread that will determine the total cost of your trade, but also the lot size. We will get into more details about pips and lot size in future lessons. Going back to spread. Remember, every forex trade involves buying one currency pair and selling another. The currency on the left is called the base currency, and the one on the right is called the quote currency. When trading FX, the bid price is the cost of buying the base currency, while the ask price is the cost of selling it. To calculate the spread in Forex, you have to work out the difference between the buy and the sell price in pips. You do this by subtracting the bid price from the ask price. For example, if you're trading GBP USD at 1.3089 bid and 1.3091 ask, the spread is calculated as 1.3091 minus 1.3089, which gives us 0.0002, or 2 pips. Spreads can either be wide or high, or tight or low. The more pips derived from the above calculation, the wider the spread. Traders often favor tighter spreads because it means the trade is more affordable. If a market is very volatile and not very liquid, spreads will likely be wide and vice versa. For example, major currency pairs such as the Euro USD will have a tighter spread than an emerging market currency pair such as USD ZAR. However, spreads can change depending on the factors explained next. So why does the spread change in Forex? The spread in Forex changes when the difference between the buy and sell price of a currency pair changes. This is called a variable spread, the opposite of a fixed spread. When trading Forex, you will always deal with the variable spread. The Forex spread may increase if there's an important news announcement or an event that causes higher market volatility. One of the downsides of a variable spread is that if the spread widens dramatically, your positions could be closed or you'll be put on margin call. Always keep an eye on the economic calendar to stay abreast of upcoming financial events. I will discuss these new terms further in future lessons. Let's sum up what we have discussed. A Forex spread is the primary cost of a currency trade built into the buy and sell price of an FX pair. A spread is measured in pips, which is a movement at the fourth decimal place in a Forex pair's quote, or second place if quoted in Japanese yen. To calculate the Forex spread, subtract the buy price from the sell price. Forex spreads are always variable. Spreads can either be wide or tight. Traders often favor tighter spreads because it means the trade is more affordable. If a market is very volatile and not very liquid, wide spreads may occur. If a market has high liquidity but is not very volatile, tighter spreads may occur. Factors like important news announcements or an event that causes higher market volatility can cause spreads to change. I hope that you have learned a lot from this section. and I look forward to seeing you in the next video.